Welcome to the November Galileo Capital monthly update. I'm joined by Katlego. Kat, it's been another very boring, uneventful October. Nothing's happening in markets, nothing to talk about.
Hi, Warren. Good to be here. Yes, uneventful, but good to see markets rallying and returns coming through for clients. But one good thing that has come through, hot off the press, is South Africa being removed of the grey list. What's your thoughts on that?
I think it's a wonderful, kind of a wonderful event. It's always bittersweet because on the one side, part of me wants to say we should never have been there in the first place, and getting off it is something to be happy about, and certainly the trick now is to remain off the list and to stay where we are. But I know the president in his kind of weekly newsletter to the country said it's great news and it shows reform, etc. I think it just shows a bit of lost ground that we've recovered. So we dug a hole, it got deep, and now we're out the other side. But having said that we are on the other side, and we are relatively fast in terms of going from grey listing to being back on the good list again. And certainly, one of the quicker countries in the world to have achieved the recovery. And it's probably something not spoken about very much, but when you get onto a grey list, it's often a sign of continuing decay. So you get onto the grey list and you don't recover. And so the fact that we did and we bounced is a very good sign. And I think a place like Mauritius did it a bit quicker than what we did. But beyond that, it's not over, right? I think you like that's a point you want to make is we it's not like the work's just starting, but the work will continue.
Yes, Warren. I think I share the sentiment that it's good to see that we were able to put the necessary regulations in place and improve our regulations and whatever needed to be done. I think it's definitely good to see that we were able to do that. And I agree, we shouldn't have been there in the first place, but yes, we're through it now. But I just want to also remind our clients that, it means that we continue to follow the regulation. So it doesn't mean now regulations will be relaxed. It means we continue to follow the same processes. We still need to comply. And I acknowledge that, it is frustrating sometimes, especially when dealing with companies and trusts trying to open accounts. There's lots and lots of requirements and understandably frustrating to clients. But yeah, we continue to ask for their patience and understanding because we now need to stay off the grey list, which means we'll continue to make sure that all requirements are fulfilled before we transact or open accounts.
Yeah. I think maybe just also to say that, when a country goes off the grey list, it's a little bit like when we were put onto it in the beginning. Nothing changed on day one. But, gradually the screws were tightened. Gradually it became more and more difficult to do business, especially international transfers, opening accounts. I think we really struggled doing euro transfers, for example. And so coming off the grey list, I think the same process will apply in reverse. In other words, our lives don't get immediately easier with international business. What will happen is the international banking system will kind of acknowledge that we've been put on the good list, and gradually they'll loosen their kind of enhanced due diligence requirements for transactions. And some of the banks, which especially the euro-denominated banks, which just blacklist a country when you're on the grey list, they will put change their systems. So day one, nothing really changes, but 30 to 60 days later, we should see a marked change in the way that we can do global business. I do think you're right. I think we obviously don't like doing huge amounts of paperwork when we're taking somebody on as a client, and then somebody that's been an investor for 15 years, asking them for updated proof of address and updated ID and all of that stuff, and bank accounts. We've had a few unhappy conversations with clients who are kind of, don't you know who I am questions, but that is the reality of being on a global compliance standard. Is due diligence is required every 1 to 3 years, and so every 1 to 3 years, depending on what the regulators say, we'll be asking for updated proof of address, bank, and the like. And so we can't stop that. That's part of the law now. And if we want to stay in the global system, we'll do that as a country. And certainly as Katlego, we want to make it as seamless as possible, but at the same time, we will always comply. And I think we've always had to comply a little bit more than just as a South African business because of our global investments for our clients, and so we make sure that will continue. But if you own a trust or a company, I think you just need to make peace with the fact that you need a current kind of FICA pack, and you should keep that updated all the time. It's not going to go away, and just be ready for banks, ourselves. Most financial institutions should be asking for that stuff. And if you think there are no consequences. Every now and then you can just read about how the FSCA is fining financial institutions for breaches of FICA. And it's very often around this. It's not about not checking your ID the first time. It's about not checking your ID, 10 years later, and checking your proof of address 10 years later, and confirming your bank account details 10 years later. So it is very important to stay on the list. I just want to, I know I'm talking a lot, Kat, but I just want to talk about, the trajectory of reform, because, grey list is a sign of improved policing of financial institutions and financial transactions, and then also some laws which were updated and modernized. But it doesn't, for example, help with things like our credit rating. One of the things we mustn't forget is we're still below junk status, and the thing that will turn that ship is when you see, for example, current account surpluses, which we now have as a country, where we have a primary surplus, as where the tax revenue that we collect is more than the expenses of the country, ignoring interest. When you add interest to the conversation, we still have a problem. But the starting point is to stop digging the hole deeper, and financially we've done that. What we need to do to get off that, the junk status, I believe, is push up our economic growth rate from around 1 or 1.25 or whatever it is at the moment % per year. That needs to shift to somewhere around 1.5 to 2% a year. And then I think the whole uncertainty around NHI is weighing on everybody's minds. And I think credit rating agencies don't believe the country can afford NHI, and so they're probably not going to re-rate us, even if our GDP growth improves, until NHI is resolved. So those are kind of things to look out for, but there is good news. And I mean, I think you mentioned something which we should talk about as well, around signing new trade agreements for our fruit farmers.
Yes, South Africa has signed a trade agreement with China, and that's looking positive in terms of being able to export our fruit to the Chinese. And I think that will certainly go a long way in helping jobs, the agricultural sector, and also I think easing the pressure with uncertainty around the world with this global trade and tariffs. There's certainly something positive for South Africa.
Yeah, I think if you add to that the improved performance of the ports, and now the progress around Pier 2 in Durban, with that public-private partnership going ahead full steam now. That's not specifically going to help the fruit industry very much, but certainly there is a dramatic improvement in the port performance in Cape Town, which does help the fruit farmers quite a lot. And as we see Durban Pier 2 improving as well, we will see more and more exporters kind of not complaining about backlogs and log jams at our port. So again, another decent sign. So there are a few green shoots of recovery all around, and we shouldn't lose sight of that when we get bombarded with really kind of reams of bad news, and they are accurate. I'm not saying they're wrong, but around policing and the corruption, at a national level, there are some other signs of good news as well, and we should always maintain that sort of balanced view.
Yeah, I agree, Warren. And I think for myself personally, as a South African citizen, definitely good to see things turn around and move the right direction in certain instances. I think we've said a lot about what's happening locally. You've recently been on a trip to China, and you did a special update to our clients on it. And then I've had some discussions with clients, and I just wanted to check in with you. Does this now mean that we are increasing allocation to China? What does this mean for our clients?
It's always a tricky situation when you want to do an update and maybe a country or region specific kind of feedback to our clients where it might create the impression that suddenly we're going to move all of your money from America and Europe and the like and bang it all into the Chinese stock market. That's certainly not true. And if you haven't had a chance to see that update, there will be a link in the description below, and so when you're watching this, you should be able to get a link to that video as well. If not, on the Galileo YouTube channel, you'll certainly find it there. Maybe 2 comments just to summarize. I don't want to rehash that video, but the one is it emphasizes a view which we've had for a while, which is that we think there is good value in developing markets around the world. It feels very strange to say that about a place like China, which is the world's second biggest economy, and it's far larger than many of the so-called developed markets, with much better prospects for growth going into the future. But having said that, we think that their markets, India, Southeast Asia, maybe a few places in South America, they tend to represent better value at the moment than what we could find, for example, in a few tech shares in America. And that's not a new view based on one trip to China. That's a view we've held for a time. And so it's maybe just to emphasize that valuations in emerging markets are attractive, and South Africa is no exception to that story. We kind of had a lost decade as emerging markets, and I think that cycle is busy switching to kind of a bit more favorable conditions for emerging markets. And then maybe just lastly that there are some phenomenal entrepreneurs and some phenomenal businesses that are operating in China that are gradually becoming global companies. And certainly, when our clients look at their portfolios and they see that we're slightly underweight America and slightly overweight emerging markets, that is the reason for it. We're tracking good businesses, good entrepreneurs, and good valuations as a balance to what is an expensive market in the US, and always in a situation like this where we preach the kind of the gospel of diversification, and that's not going to change. So we won't become massive single country investors in China, but certainly we will be more invested there than a lot of other companies would be.
Yeah, no, definitely agreed with you, Warren. Good to see that the principle of diversification is working and working well for our clients. This has certainly been a good year to be in markets, good year for our clients, seeing decent returns, double-digit returns. But you're always talking about valuations, and at the moment there are sectors of the market that are, valuations are just stretched. And you often mention valuations being like gravity. Break that down for us.
Yeah, so the thing about a company that's expensive, and when we talk about valuations, we're not really talking about share price. What we're looking at is the share price compared to the profits that the company generates. That's the price earnings ratio. And when a company is very expensive, in other words, the price is very high, per share relative to how much profit you're going to get for each share that you own, then you need to understand that is the equivalent in financial markets of gravity. It doesn't mean that something can't carry on rising for a time, but eventually gravity will kick in, and either the price needs to come down or the profits need to grow at an accelerating rate. And so when we see a sector, and I think the tech sector in America is a very good example, that's now very expensive. You can't call it anything else. There is a chance that the prices carry on running for a time, so it becomes even more expensive. There's a chance that the prices go sideways, so they flatline, and there's a chance that those prices come down. And we're not in the prognostication business, so we're not going to give you a forecast and tell you that we think prices come down in 72 days' time, because we have no idea when they come down or if they come down. What we do know is valuations matter, and when valuations are high, performance will be, in the next 5 years will not be nearly as good as it was in the last 5 years. So equally, when we look at other sectors of the market, and I've just spoken about emerging markets where valuations are low, that means they're operating in a low gravity environment, which means that there is an opportunity for them to do well. Whether they'll do well in a month or in 6 months' time, who knows? And so we look at valuations as kind of a true north, and we know it helps us to understand the state of certain markets, but it doesn't help at all with market timing. And so I just want to say, maybe when markets have been going down for an extended period, one of the things we'll tell you is, a phrase we use often is, "This too shall pass," and that's kind of telling investors that eventually the downward markets will end. There'll be a recovery, and the upward markets will kick in. And you have to have the same philosophy when a market has been running and recovering and rising strongly for a period of time. This too shall pass. And so we're just cautioning that we don't know that the markets will correct or fall tomorrow. I think that would be very brave or stupid of me to make a prediction like that. But what we do know is that different sectors will start to perform. And again, back to the diversification argument, when we don't know what to do, we make sure that we're incredibly well diversified. And we certainly know we've got no ability, and we don't think anyone has an ability to forecast. So diversification of equity markets makes a lot of sense. And when you're looking at a sector of the world that's incredibly expensive, then it makes sense to reduce your allocation. And that's certainly something that we've done. But again, just to emphasize, that doesn't mean we've sold all the tech shares and we don't own any tech anymore. We've just reduced allocation. If tech makes up, as an argument, 20% of the world index, we might be at 15%. We haven't gone to zero, because the tech sector could carry on running for a while. Share prices could go sideways while profits increase. So we'll continue to watch, we'll continue to diversify, and we'll maintain a discipline of making sure that we never overexposed to the wrong expensive assets at the wrong time.
Thanks. Thank you, Warren. I think good to see that we are sticking to our fundamental principles when it comes to investing, and sticking to our philosophy. And that's diversification right across the board. And it's something I think we work on with clients from the beginning, making sure that the asset allocation is right for them and right for their needs, and making sure their portfolios are well diversified. But as always, if anyone has any questions, please reach out to your financial planner and have a discussion. But it was very nice to chat to you, Warren. I think let's leave it there for this month. Any closing comments from your side?
Yeah, thank you, Kat. I think maybe just to say, we are watching inflation moderate around the world, and so there is a chance that between South Africa, the US, maybe a couple of other countries, that we see not big, but maybe 1 or 2 interest rate cuts, and those if they happen will be positive for markets. So worth watching that. Also worth watching if reforms in the Japanese economy continue. They have a new prime minister, the first female prime minister in their history, and I have this view that the global economy tends to perform best when you've got at least one female prime minister of a very large economy. And certainly we've got that again. And hopefully she'll bring some sanity to some of the other men who are behaving badly around the world. So that's not a prediction. It's just a hope, I guess. But certainly, she is very market orientated. She does want to drive Japanese companies to focus on profits, to focus on shareholder returns. And if that and their kind of seems like a good relationship with America continues, that might be a nice economy to watch, and hopefully that delivers some stock market performance that's very different to what we see in the US at the moment. Again, just something we're watching. We'll continue to monitor those things, but maybe I should just preempt any questions. That doesn't mean we're now going to go and allocate all your money to Japan. It just means it's something we're watching, so something to talk about and something to look if you're watching the news yourself. Watch that space. For the rest, we look forward to chatting again with you. I guess it might not be me or Kat, but in the December update to kind of wrap up 2025. So far, it's been a fantastic year in terms of stock market returns, and it feels to me like a little bit of payback for 2022, which was a very tough year, and maybe a bit of recovery also from the last decade of the Zuma years in a South African context. So we could see the JSE still continuing for a while because we're in no way expensive. But we'll watch this space and we'll keep you abreast of anything that we think you really need to know. Thank you so much for watching, Kat. Thanks so much for the questions. I see I spoke far too much once again. I'll make sure I get you to talk more next time.
Thanks, Warren. It was good to be here.